Good afternoon, Scott Redler, T3Live. Welcome to today's recap. So the market opened up pretty big, nice jobs number early on. I think some scrutiny came in on, okay, they're getting less and less claims out there, but maybe there's a lot less of them allowed to claim them. But anyway, plus you also had holiday workers. All in all, there was a recipe for a rally, and the question was, what type of rally were we going to have? So that's why we tried to put resistance 1, resistance 2, try and figure out, is it a tiny feeble bounce, or maybe it gets a little bit of traction. So I talked about, I think it was like 122.80 to 123.20 as resistance 1 in the spiders, and then 124 as the other resistance. And then obviously, if we did fail, where we would go on support. And what happened was, off the bat, a lot of people who are trying to trade from the short side on the momentum side of what's been working, these momentum stocks getting weak, they got paid early on. And if you try to, buy after the first 15, 20 minutes of a gap up, you didn't make any money. And that's why people are getting frustrated. If you tried catching a little bit of an oversold bounce the past 2 days, you weren't rewarded at all. And then today, the market opens up 120, in the first 15 minutes, and then closes up 55 or so. So in other words, anything you bought after the open, you lost on, and anything you tried to buy during market hours the past 2 days, you lost on. So really the only money being made intraday is really short or buying after, some type of, quick capitulation move down, which sort of worked also. But anyway, it's really that sniper approach. It's not positioning right now, because positioning for what could be a move is just not the way you could prudently make money. And at this point, it's more neutral to negative versus neutral to positive. And I've been trying to talk about that ever since the Fed came out with their minutes and we failed intraday. So if you look at the chart of the S&P, you'll see, not much of a bounce. Obviously, I tried to talk retracement numbers. I'll do it one more time. I'll probably do it more than one more time, but I'll say I'll do it one more time. This was that move from October 4th. Boy, do I wish we were back here. Didn't this feel like this was a decade ago? This was a fast, furious move. Your outside day, you're holding higher, you're breaking of this downtrend. It held above it and continued to 1292. I wish this was the whole, from October. I wish this was till December, and they spread it out. That would have been a nice tradable move, but obviously the market's moving like an elevator, not an escalator. Then you had, this move lower. Okay, remember this little wedge within here broke to the downside. Okay, and then what did we hold? We held that 61.8 retracement level, which was really that last line in the sand before that ECB news came out, and you had a big move back to the resistance where we failed the first time, and then we tried holding up, and now we've been just like trickling lower. We're getting below the moving averages. Resistance is starting to line up. You want to do the Fibonacci retracements again from this low to this previous peak around right here. And if you want to take another look the same type of way, that really that 0.618 that held here, is right around 120, and that's right around, where this uptrend comes into play. So really, from a macro standpoint, this is about all the room the bulls have left for any kind of constructive nature. But at this point anyway, IBD still has us in a correction. So according to them, you're not allowed to buy stocks. You can have a watch list, but you can't buy stocks. So you don't buy stocks in a correction until you get a confirmed rally. There are a lot of guys that we follow technically that are also in like 90% cash. So most of us are in 90% cash because there's no reason. But then if you're going to be in 90% cash or more, you get a gap up like today, you can't be upset. You just have to figure it out. And there was a lot of money to be made from the short side if you did so. A weak stock like Baidu that opened up, massive move lower off the front. This was that wedge type formation. It broke below, 3 days back, broke this minor uptrend, and it opened up and then got crushed. If you look at the 5-minute chart, you'll see that if you shorted that up move, you made a lot of money. Okay, if you had continuation on the brain, you did pretty well here. Here you go, boom, before it started to just regroup a little bit. But it broke that afternoon range, and it happened pretty quick. As far as Apple, I know I messed that trade up. I tried to be long. I thought they would shake the tree a little bit more, but you know what? I was wrong, and I missed an opportunity because this is one of the things I probably would have faded. So it opened up. Okay, you tried to buy Apple in this gap up. Right here, you got screwed. Not get screwed, but it wasn't fruitful. And then it filled the gap. So this was really, but this is day trading 101. So I messed it up. It's, you have a big move off the lows from 378. You close okay, you gap up. You always fade an opening gap to see if it could hold in. If it holds in, then you play it higher. If it doesn't hold in, you see if it gets filled. It got filled. Never even attempted to get back above this area. And then little by little, just did nothing before, closing pretty much, near the lows. And now if you look at the chart of Apple on the daily, to me, this is getting, pretty ugly to the fact where it's almost really bearish. Here is, definitely some type of head and shoulders pattern building. And it's a little sloppy and it's not exact. This is more like the macro where you have the left shoulder, the head, here's the right shoulder. And we're definitely getting some type of neckline here. Some type of neckline that held here, flashed through, came up, closed below, gapped up. And, you would have thought that with 2 upgrades today on Apple, you would have had a better move than we had, off of this area. Nice trades along the way. I think I wish we were back here too. Remember when it looked weak and we had that great short through 394, talked about it on CNBC, gave you a nice move down. This was a nice calculated move down from this breaking point. Never filled the gap from earnings, so it showed you that it was that weak. And then you had a move down. Remember that other little descending channel that we tried to draw in here? This was that 376 buy for an oversold bounce off the 200-day. And look at this. Looks kind of familiar. Here's a flag type pattern. At first we were trying to play to see if it could continue. Then you had this ugly bar on Fed day. Had some follow through yesterday. Guys did pretty well from the short side, and then today nothing. So if it can go sideways or open up a little bit tomorrow and starts trading through this to me looks much more like a short than a long at this 377. 377, now all of a sudden you're talking, 200-day all over again. And then once again, on the macro level, pretty bearish pattern here if this starts to trigger. If this triggers, going to be a lookout below, and that could be a really good trade. If you go to the weekly chart, look at the perch that it's on, it's got some room. And this is another longer-term trend line. If you draw from here, right? Actually, it's sort of broken right here. Let me see that for a second. I haven't even really looked there. Besides that, okay. So this one comes in right here. The longer-term trend line, I guess you could say, was sort of breached when it broke, this last box pattern around 390, and then it, came back, tested this one, and then retested, and now, this is definitely going to be an interesting area in Apple. You look at RIM at 15 bucks. Anyway, as far as some other stocks, Google still hanging around. It lost some short-term momentum. Longer-term it looks fine. I came in long it today. I sold it on the open. Thank goodness I didn't play that messy game today. Google itself, a little bit of a doji here means indecision up here, so it could lead to a move if we correct down to this 590 or 601 area. You go to your daily, still hanging around. This was that, if the market was healthy and we were in a little bit better times, this bar would have closed through the highs and it could have started another move here, but it didn't because of the way the market is. They sold it. That gave you a little follow through to the downside, and now it's hanging around. But unless you're really that committed and you're going to hold this thing for months, you might want to be really light, because if it does break and the market gets hit, you're going to be holding this thing to 592, which is, could be 30 bucks and still be fine. So just know what you're looking to do here. As far as gold really, didn't bounce much. Typically, when stocks and sectors break their 200-day, it's really bearish. Longer term, gold is funny where they try and make everyone feel as stupid as possible. So sometimes they break it below the 200-day, get everyone out, and then within the next few sessions, it reclaims it, and then it goes. And Alex said that statistic today, how 2/3 of the time within 1 week to 3 months, it's a lot higher than it was the sessions that broke below the 200. So that's going to be a good measure that if it doesn't get back above the 200, in the next week, it's going to show you its hand going into 2012 first quarter, and that in the GLD, could be could be another sizable move lower. If you guys remember, GLD, here's your your outside day when it tried to break through the highs and couldn't. That was a sell signal. Then you remember this outside day right here when it had a little flag pattern, tried to go, close no lows. Some people actually got short or got out. Boom, big move lower. Then you had a move back to retest. Then it wedged again, and then it broke below. Unfortunately, these things gap a lot, and that's what it did again here. And now it's below the 200-day, below all these moving averages, which are going to be like a wall of resistance if it ever gets back up there. And then here, And then if you go a little bit longer term, it's it's pausing right at this prior breakout from July. But if it goes sideways and doesn't get moving at all, if you look at the weekly chart, it still has a decent way to go. I would say, I would give this at least a 50% chance that we see about 140 or so, at some point in Q1. If you remember last year, kind of did the same thing. Remember, it came up, gave you a nice little move lower before Egypt and everything going on went on in the Mideast, or like it was Egypt and then it was Libya, blah blah blah, whatever it was. It corrected in the first quarter and then went. So this could happen right here. So we'll cross that bridge when we get there. And then obviously the 200-day on the weekly is all the way down at 120. Wow. So if things were really, if gold was really to get liquidated, if Paulson gets a big margin call, since he's already down that much, you could see that this is a wide range bar that resolved with strength. So it's on that moving average, a little sideways action, no bounce. It can continue. As far as some banks, if you want to take a quick look at Goldman, not bouncing at all. You had another feeble bounce, versus this October low. Gave you some money to be made, and then I drew this line in the sand saying if it crosses back below 99, it's game over, or game over for that move. Same way, if you remember here, said the same thing. If it crosses back below 102, this mini up move, which is all you could play here, is mini up moves. You had a descending channel here. You remember, broke to the upside, gave you some action, and then that was it. Here you go again, even a little less action this time. So it doesn't look to me as if it's very healthy. Look at that wide range bar closing on the lows. That's not good. Let's see what Bank of America looks like. Sneakily back to 526. Last time we talked about it with Jill, she hated it. It was a great call. I thought maybe there'd be a little bit more room, seeing this bull flag. But then once you get this wide range bar in there, it's got to wake you up, and then pow. Now it's you really have to look at this level going sideways. So if it starts breaking below this area, you're going to see some psychology, where some arms get raised in these financials again. As far as the OAHs, that's what happens when you try to anticipate a right shoulder. That's why I like to buy strength, not weakness. It hasn't seen a friend this entire way down. I started buying in here thinking maybe I could buy versus pivot. I've been in it a little bit longer. I'm still there, even though I probably should be stopped out because, the reverse head and shoulders was on Mad Money, and Kramer said 108. And since he quoted me, I have to stay into 108 because we have compliance. So, left shoulder, head, right shoulder. This pattern, some would say it could get down to 100 and still build the right shoulder. And then this downtrend will just extend lower. And then maybe, if it gets down to here or so, then this is when it starts to work. But until then, it's just dripping, and so are those stocks. As far as some retail, it was amazing what one analyst could do to a stock like DEC. It's been one of the strongest stocks out there. I don't know how it closed, but if you take a look here, shows you how dangerous things are. Wow, look at that. It looked weak as it is anyway. This is when the flag broke to the downside, when momentum left the stock. That's why with momentum stocks, even in retail, you have to think clearly or watch things close. And then you had a big resistance area right here that it closed below. So if you were still in this thing, you should have been out. You could actually even see a little bit of a head and shoulders formation here. Left shoulder, head, right shoulder. So it actually closed through the neckline. So those that actually took it home short, because some people probably did that, got paid. And this is just broken now. Maybe it fills the gap for a trade, but that's pretty ugly. Under Armour, held by a thread. But I wouldn't really trust this that much if something like DEC could get so beat up. Did hold the 200-day again, but we'll see what happens from there. As far as, let's see what Lulu looks like. Nothing really. Just trying to grasp this lower level. So I don't see anything that looks really good at all. Everything looks like it's either trying to grasp at lows or roll over even. Let's take a look at Macy's. Macy's. This was at upper level. I guess when that Best Buy news came out, this was that day. It claimed almost half of it, so I guess we'll see what happens there. If it can't get above this, I would just be careful, keep some stops right around there. And then, last but not least, the Ags. Really, it came below. Actually, no, this is my line. It's hovering right here on support. Still can't get above this downtrend. Has a lot of room from this little support area down to where it bottomed in October. So you just got to be careful there. There's no sign yet. You know, some people like to be involved in cost averaging and wait. I like to look for that day one sign to at least give me some kind of clue that there's some volume, some interest, and you know these things could be ready to go. You saw that obviously with the spiders here, okay, and you saw that with many stocks here. You know, so you didn't really have to anticipate on this down day, this down day, this down day, this down day, this down day. You wait for a big day like this, which you didn't see any of it in here, you know, and then that's when you get going. So right now, you know, after the distribution and the you know the confirmed correction or whatever we're in right here in this mess, there's no reason to be here until you see, you know, something maybe like this, like a big boom, engulf something, you know, but we haven't seen that yet. And anyway, so with all that said, most people that are the least frustrated right now are the ones coming in flat every day, trying to be long, trying to be short, picking spots, not looking for much, happy with what they get. And that's probably the way it's going to be going into year end. So just accept it. You know, until we see some type of composure change, until things get a bit more interesting, just come in every day with a clear mind, try and make a little bit of money. You make a little bit of money, that's cool, it's December, go to the gym, go shopping. You know, look at things from a bird's eye view. There's no reason to sit all day long and drive yourself nuts, because traders that are sitting at their desk all day long are driving themselves nuts. If you're not seeing it, you're frustrated, take a week off. You know, a lot of traders in the office are going away, you know, through Christmas or from Christmas through New Year's to recharge their batteries. Guys I know at major hedge funds are already away. So there's nothing wrong with taking some time off, recharging your batteries, calling it a year, because you're not going to miss something. The market will be here in January. But if you go in the next 2 weeks and knock your head against the wall and lose a lot of money, you're not going to enter the new year on the right foot with the right set of rules, with the right disciplines. You're going to be too battered and bruised to see things clearly. So all in all, there is movement. There are some things to do, but not a lot. Just take it what it is and accept it, because you can't control the market. You can only control your actions. And you know, every day will be a new one. Tonight we have our holiday party, so tomorrow the morning call will be a little bit late, but there will be one. You know, the office will probably be a little bare, because that's what happens after a long holiday party. I'm sure you've all been there. And if I don't see you tomorrow, have a great weekend, and we'll just take things back up on Monday. Have a nice night.